Once you're pitching to a VC, you should mix the two. You should also be strong with numbers, that you should know, hey, these are my numbers, these are the numbers of my competition, this is how industry is behaving. And then of course, why you are the best guy to build this business. You need to have a strong story.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast. And today we have Pushkar Singh with us. Pushkar is a co-founder at Tremis Capital, where they are investing in startups and also helping post-PMF startup construct their rounds. In this episode, we talk about what is Tremis Capital, fundraising tips for founders, who should and who should not angel invest, how should new angel investors approach angel investing, equity versus debt financing options for startups, why is now a great time to build a business in India, and lots more. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast 10X, where I help VCs start and run their own podcast. While I was running VC 10X, this podcast that you're listening to right now, I asked my VC guests, why don't you start your own podcast? I mean, it's the best form of marketing for VCs. As they say, VC is a people play more than even a capital play. A podcast enables you to put your people at the front, your portfolio founders, your partners, and co investors. It's a great way to build a brand and win competitive deals. It activates all your marketing channels in a single shot, be it YouTube or blog post or newsletter or social media. Everything gets activated in a single shot. And I get the same response from all the VCs that it's a lot of work and we don't have the time for it. I said, all right, let me handle the work for you, from pre recording, editing, publishing to making social media clips. All you have to do is show up on a call, hit record, do the recording using the well researched outline we provide you with, and you're done. We handle everything else. You know what they said? All right, let's give it a shot. So if you are a VC and want to up your marketing and branding game, I'd love to work with you. And if you're thinking there are too many VC podcasts already, remember there are way more VC firms out there. And if you're not standing out, you're losing out. So if you want to work with me on starting your podcast, go to podcast10x.com and book a call today. I'll add the link in the description and show notes below. Look forward to working with you. Hey Pushkar, so good to have you on the VC 10X podcast. How are you doing?
All good. My pleasure, Prashant. Thanks for having me.
Yeah, it's a pleasure having you on. To start things off, can you give us a quick background about yourself and what you're building at Tremis Capital?
We started Tremis in 2019 as a deal advisory firm. A deal advisory firm is a firm that helps startups raise capital. It can be early stages, late stage, mid stage, whatever. That was our idea. And then eventually we realized that there were a lot of exciting founders who were at a slightly earlier stage where maybe we can't help them in raising capital, but we can invest in their companies. So we started investing through our Tremis syndicate. Our syndicate is a group of investors that come together, invest in a startup. We have a syndicate on AngelList India, AngelList US. And right now we're also trying to build a content company in Tremis, where we want to eventually create a platform where we and other people can come and sell courses around angel investing, startups, digital marketing, how can you grow your startup, everything related to venture capital and digital marketing and startups. This is the plan.
Got it. Got it. Thanks for that brief introduction. And now, since you've also started a syndicate, and this podcast is more into investing, right? So let's start with that aspect. How do you evaluate the startups that you're planning to invest in or thinking of investing in?
We invest in, I would say, relatively earlier stages. So not at a business plan level or a pre-revenue stage, but broadly, once the startup has launched its product, there's some revenue. At that time, we like to come in. You can call it maybe like a post-seed or pre-series A round in India. We like to co-invest with a larger VC. So any startup looking to raise upwards of $1 million, and if there's a lead investor who is putting in 500K or let's say 700K, we can quickly join the term sheet, chip in with 100, 200K, both in India and in the US. What we look at, so at such an early stage where, of course, there's some numbers, there's some traction, but I think the team is most important. We like to, we speak multiple times with the founders. We like to back startups where we think founders are excellent. They can grow the company. They're the right people to build that business. And this is the right time to build that business. So I would say two things. One is founder, team, and the second T is timing. It has to be the right timing. And then, of course, there are other parameters like traction, like how quickly they have grown, how, like, what has been their revenue growth, also technology, what kind of product are they building, are these the right guys to build the product? But eventually it's about the team and timing.
Absolutely, the two T's there, right? Awesome. So now, one thing that you talk about a lot is helping founders fundraise, right? And that's something that is also a very crucial skill for any startup founder, because a lot of time goes into it, and uh, the better you can be at it, the better it is for the business, right? So you also run, I think, a course on that aspect at. I think that's a part of Tremis Capital, from what you mentioned. So, can you give some tips for maybe founders who are maybe first time founders on how they should tackle fundraising?
Most founders that we have met, I believe they know a lot about product, the product they are building. They also know decent amount of things about the competition. What are the different products in the market? How are they better? Or what is their advantage over them? Unfortunately, most don't come from a finance background. So they're not really aware about like how do you value startups? What is valuation? How do you track metrics? What are key metrics to track? Indian founders in general are also not compelling storytellers. They are not really great at articulating their vision, even though they're great at building product. If you're a founder and trying to raise money, let's say your first round, it could be either a friends and a family round or an angel round, or you want to raise money from a tiny, like an early stage VC fund, a seed VC, you have to check a few boxes. Number one is you have to know your numbers well. How do you know your numbers well is you have to start tracking them. We advise all the founders that the day you build a company, even when there's no revenue, you will have some expense. It's a great idea to start tracking all the numbers, all your expense numbers in different categories. You don't need a fancy software to do that. You can do it in Excel file. Eventually, once you start making revenue, you should start also tracking your revenue numbers, your cash flow numbers, how much, if you're spending anything on acquiring customers, what are organic customer acquisition, inorganic, and every industry, of course, has different metrics. So you have to track a metric. You need to become better at storytelling. And then once you're pitching to a VC, you should mix the two. You should also be strong with numbers, that you should know, hey, these are my numbers. These are the numbers of my competition. This is how industry is behaving. And then, of course, why you are the best guy to build this business. You need to have a strong story. The course we are doing is a bit around these lines.
Got it, got it. And especially around the storytelling aspect, you're saying that that's where you see that a lot of Indian founders need help with. So, what are some key things that founders can keep in mind while uh, trying to improve that storytelling aspect? How do they construct their story?
It's a good question. And I'll tell you, Prashant, it's not a rocket science. It's not that you have to become a quantum physicist or a rocket scientist to become good at storytelling. It's just that it comes with practice. Most founders we meet, and a lot of founders who pitch to us, we find them underprepared. I don't think they have even practiced their pitch before. Sometimes they take too long to complete the pitch. Sometimes they don't know where to stop, what areas to focus on, what areas to quickly go through. And this can only come with practice. There's a lot of interesting content on YouTube, on internet, all free content. There are so many founder interviews you can listen to. You can see that. There are great podcasts, something like yours. So once you do a lot of, like, once you hear a lot of things, once you practice it enough, you eventually become better at storytelling. Now you don't need to be a Jeffrey Archer or a Paul Graham. Like, you don't need to be the best storyteller in the world, but you need to be a certain level so that you can explain your vision, that hey, this is what we are building, why we are building this, why this is the right time to build it, why we are the best guys, how we are better than competition, and back all your assertions by numbers, your numbers, industry numbers. And that's job done. You don't need to do anything else.
Absolutely. And I've heard it a lot from a lot of VCs as well as founders that fundraising can become a full time job of a founder, right? And then who takes care of the business at that time. So it becomes very important to have a system around it, right? So, how do you advise founders to construct this system for fundraising?
It's an excellent point. Again, I missed out on that. As a founder, you should have a checklist. So fundraising is always about checklist. First of all, you should know, let's say, how much you're raising, how much capital to raise. Now, most people don't have an idea. So there are ways to think about it. For example, one good way is, let's say I'm at a pre-seed level. I don't have a product ready. So I should be trying to raise enough money that can help me launch this product, build an MVP, maybe acquire a few customers. You should be able to do it in 12 to 18 months. So that is one checklist, how much capital to raise. Secondly, whom to raise from. Are you right now ready to raise from a VC, from a family office, from your network, from angels? Whom should you target? And then eventually, a lot of founders we find are not very prepared about how they're going to use the money. So let's say I want to raise at a very early stage $500,000. Now, as an investor, I would be curious to know, hey, you're saying $500,000 number. How did this number come from? Like, will this number help you to launch the product? Will it help you to acquire some customers if you already have a product in place? How you're going to use this number to use this money to take your startup to the next level? So you have to prepare these things. And then, of course, like by checklist, I also mean that you should know which VCs to approach to. If you want to raise money from a venture capital firm, you should know, like, all right, these guys invest in early stage, they invest in late stage. What is their investing thesis? Do they like to invest, co-invest? Do they like to lead the round? And all this information is there on the internet, on their website. You just need to do some research.
Right, absolutely. So it's basically like creating your ideal investor profile first and knowing how much you're looking to raise and who is going to put in, who has the ability to put in that much and has the willingness to put in the space that you're operating in. And then maybe building a prospective list from that and then going out and targeting those and almost treating it like a sales approach, right?
It is a sales approach
Yeah.
because let's say you approach 50 investors, or let's say we start with 20. You make a list of 20 investors. It's unlikely that all 20, I won't say unlikely, it's impossible that all 20 would reply to you. So, like you said, it's a sales approach. You know
Right.
that, hey, these are 20 guys I need to approach. If this doesn't work out, I should have a second list ready. That if no one is interested in these 20 guys, maybe I should refine my pitch a bit. Maybe this pitch is not working, this deck is not working. And then I check my second list, and then so on.
Absolutely. You just touched upon the deck, right? And that becomes a crucial aspect, especially for early stage founders. A lot of them haven't worked on a deck yet, right? Sometimes you talk to them that, okay, send me your deck. And they say, okay, I don't have a deck yet, but I'm going to build one. So at what stage do you think that they should be having a deck in place? Like when they have the idea, should the deck be ready straight away? Because some investors are ready to invest in the ideas. There are some investors out there, right?
Right, right, of course.
So when should they be working on the deck? That's one question. And how should they be constructing the deck for early stage startups when there is not a lot of numbers from within the company, right?
To answer your first point, I think whenever you go out in the market to raise money, you should have a deck ready. How to think about deck is you should think of a deck as your marketing brochure. That you don't know someone like you trying to sell your startup to a stranger or to a friend. Maybe a close friend might not ask for a deck. He or she would just invest on you knowing you as a person, but in 99% cases, you need to have a deck ready. Whatever stage you are at like pre-seed stage or series F stage, doesn't matter. Now, at every stage, there are different components of a deck. You should have these key elements in a deck. For example, your deck should explain what problem you're solving, what product are you building, how big is the market, how is the competition, how are you different from that, what is your team like as a founder background, why you are the right guys to build it. And then you're right, at very early stages, there are no numbers or there are no customers. So maybe you can talk a bit about tech, like what tech you're trying to build. Maybe a bit about competitors, like, hey, these are 4 or 5 guys who have built something similar, but their solution is broken or it's not optimal. So we are trying to build something better. And then eventually a bit more information on how do you see business going ahead. So maybe not a 10-year projection or a 5-year projection, but some projection and also a fund use slide. One slide on fund use that, hey, I'm trying to raise
Right.
$500,000 or whatever, 2 crore, whatever number you have in mind, how I will use it. Every deck should have these key elements. For larger companies, of course, deck will have a lot around the numbers, your KPIs, projections.
Absolutely. That's useful advice for founders. And since now we are in kind of a different environment in terms of fundraising than maybe we were a couple of years back. So, how do you think founders should be navigating this difficult environment in terms of fundraising, as well as how they are maybe building their businesses, their approach to that?
Well, it's of course true that fundraising has become difficult. It's not become so much difficult at an earlier stages. If you look at the number, I would say pre-seed or seed or pre-series capital is still there. Not maybe not as much as it was 2 years ago. But this funding mentor is mostly around slightly later, I would say Series B and beyond companies. They are struggling to raise capital. Now, one reason they are struggling to raise capital is they have not been capital efficient. There are a lot of companies in India who raised, and not only in India, all over the world, who raised a large amount of capital when funding was easy, and then they didn't use that capital well. One metric a lot of VCs are increasingly looking at is what is your capital efficiency. So let's say you raised $3 million in your or $5 million in your Series A round. Now, how well you use that $5 million? What kind of metrics did you achieve with that? What were your deliverables? Did you build the product? Did you launch it in different geographies? What's your revenue? Did you manage to cut down a burn? Did you manage to improve your contribution margins? As an early stage founder, you also have to realize that right now in India, it's tough to raise $2 million at a pre-seed level. Maybe some founder can still raise it, but it's much more difficult than what it was in 2021. Hence, you have to raise a slightly low amount and then justify that, all right, I'm raising this money. These are my milestones that I would like to achieve using this capital, and ensure that you hit those milestones. Because if you hit those milestones, raising next round would be easier. You can go to the investor and say, your existing investor and new investors, that hey, we raised a pre-seed round 22 months or 18 months ago. We had these milestones in mind. We have achieved all these milestones. Now it's time to take the company to the next level.
Absolutely, yeah. That sounds like a great approach, and the capital efficiency point is, I think, that has to be in focus here. That how companies were built, maybe past couple of years, was in a different fashion. That you were allowed to maybe burn money to grow at a rapid pace, and now it's different because capital isn't that easily accessible. So you have to be efficient with it. You have to show the results for that money in terms of tangible milestones that you're achieving. And another important aspect there is about uh, being able to convince your existing investors that you've performed well. And if they come on and invest in your new round as well, that's going to be a big plus for you in terms of acquiring even new investors, because they see the confidence that the existing investors are showing. And then it becomes much easier to fill the round from there, right?
Yeah, that I think that's again that's a very valid point. I'll tell you why.
Right.
Because when we invest in startups, usually we invest in companies that have raised some money before. It can be a smaller check, need not be a $10 million check, like a small $500,000 or $1 million check. And one filter we always use to evaluate startup is whether your existing investors are investing in your company or not. And if they're not investing in a company, we would like to know why they're not investing. Because to us, it's a kind of a red flag that, hey, you raised money from this small fund. Now you're doing a larger round. Why aren't they doing their pro rata? Because they know the company much better than us. And we always like to talk to existing investor. And sometimes they're genuine reason, because maybe the fund has no longer money left. Maybe the fund is over. They're trying to raise a new fund, or maybe this round is too big for them. Maybe they're only angels who can't really do a $20 million valuation round. These things are fine. But you should have some reason saying, hey, because if you're building a good business, your existing investors would invest, right? And venture capital is all about backing your winning horses. So if I think like this is a kind of startup that would give me a 25x or 50x return, I would of course do my pro rata, and if possible do more. So me not doing that is a kind of a red flag in my opinion.
Absolutely, valid point there. Uh, Also, now shifting focus to the angel investing aspect of things, because that's another thing that you have courses on, teaching people how to angel invest. So, to start things on that front, firstly, who do you think should be angel investing, and who do you think should not be angel investing?
Yeah, that's an interesting question. So I usually advise people that, hey, if you have a regular corporate job, let's say you're not from startup, then you should at least have some investments outside startup. Maybe you should have something in real estate, something in stock markets, maybe a bit in debt. Once, because there's no point investing your first crore in startups. It's a bad idea. You should have some portfolio. Once you say like, all right, I've invested 4 or 5 crores in different things, in real estate, in equities, in debt, maybe some commodities, some gold. And then startups or private, because startups are a part of private equity group. So private equity is a good way to diversify your asset. For most investors, you should not put more than 10% of your entire net worth into startups, into private equity. 5 to 10 is ideal. Now, of course, this is just a rule. I would say this is a very generic rule. There are people who come from startup background, and then there are these guys who have made a lot of money in startups, early stage employees or founders, ex-founders, and they understand this asset class much better than everyone else. So their asset or their portfolio allocation in startup would be much higher because they know it better than, let's say, real estate or equities. They have an unfair advantage over you. But for most people, no startup background, I would say try to create at least 2-3 crores of investments outside startup and then start taking smaller bets. Don't invest in one startup and forget it. This is something we tell in our course maybe 100 times, that it's critical to diversify. So one is diversifying outside your portfolio. So getting into startups, that is diversification number one. Even in that, you should invest in at least 15-20 companies. So let's say you want to become an angel investor. You say, hey, Pushkar, I think I'll have around 50 lakh rupees over next 2 years. Something, because I already have done investments in real estate, bonds, whatever, like financial markets. I want to invest something in startup. I would say that's a good plan. Now, don't invest this 50 lakh in 5 startups or 2 startups. Divide it over 20 startups and then invest it over 2 years. This is how you should be looking at. Invest equal amounts over dozens of startups because you don't know which of these companies will do well. So let's say you put in 5 lakhs in a startup and you put 25 in another. Now the 25 lakh one didn't do well while the 5 lakh one did well. So then you won't recover your capital, right? So you need to spread your bets evenly and equally in early stages, and also keep some money for follow-on rounds. Because if you invest in 20, maybe 4 or 5 will do well. And then you would have to invest something in the follow-on round to maintain your equity share. So this is our entire course is around that. Like how do you build an investing thesis? How do you think about investments? How do VCs think? What are startups? What are the key traits in the startup? But one critical parameter or one critical aspect is that you have to diversify evenly and equally.
Absolutely. I think that's a very, very useful point there for angel investors there. And why, and the reason why we see a lot of angel investors entering the ecosystem, investing in a few startup and quickly getting out and never investing again is because they do it in the probably the wrong approach. And not the approach that you're suggesting, because I think it's important to take a portfolio approach when you're investing into startup and not just pick one or two and just pray that those are going to succeed, right? You have to make a set of bets, and then the power law will play out and some of those will eventually succeed, hopefully, and then you can double down on those. So I think that's the approach that all VCs take, and probably some syndicates also take that approach. And I think angel investors, how it may, they might not have like a big sum of capital to invest, but even from what they have to plan it out in terms of how much is going in and how many startups I'm going to deploy in, what are the types of startups that I'm targeting, and then go forward from there, and then see the ones that succeed and then back them further, right? That's going to give you returns, and that will make you stay in angel investing for longer, right? And you'll not go out quickly, right? Awesome. That's awesome to learn. Another thing that I want to learn from you, since that's something you're also helping your clients with at Tremis Capital, is differentiating between equity versus debt financing, right?
Mhm.
And I've heard that debt financing is becoming more and more attractive to founders in the current ecosystems. So can you help us contrast the two financing options and what's better for what type of companies and founders?
So when we talk about debt, the simplest form of a debt is a bank loan. Historically in India, I would say 10, 15 years ago, there was no venture capital. Most companies, whether you call them startup private companies, they grew by founders' equity through debt and their own profits. This was a traditional route of growing a company. Now, what happened was people realized that, hey, it had like people already saw that in the US. that if you invest in tech startups, if you invest equity capital, the startup can quickly grow because it takes time to build a product. Profits eventually start coming in later. Hence, equity investment started becoming popular in India. Now, when you take a debt, the biggest advantage is you don't have to sell equity. So you don't dilute. As a founder, if I can grow a company or build a company through that, that's a great sign. If I don't want to dilute, because then I'll be the only person. I'll be the so on my team, like all founders together, will own the entire company. Unfortunately, it's not possible in early stages because there is so much risk, there is no revenue, and also most startups don't have any collateral. By collateral, I mean something you can mortgage to a bank, like a land or a building or something. And most of the money is not meant for buying machineries or working capital. This money is for paying salaries or digital marketing, something that banks are not comfortable giving money for. But there came a new product in the market around 4 or 5 years ago, or I would say 6 or 7 years ago. It's called venture debt. What it says is, let's say, and it's mostly given to companies, so there are different venture debt firms. They are like venture capital firms, but they give debt instead of equity. These are not banks or NBFCs, even though they might have an NBFC license in India. So they say, let's say you want to raise your Series A round of $7 million. Now these guys, as a venture debt, what you can do is you raise 5 million from an equity round and raise 2 million as a debt round. This venture debt round always comes along with an equity round. So you got the $7 million capital, but you only diluted for 5 million. So you got the money you needed with a lower dilution. How do you repay this debt? Is when you raise your next round, maybe you can use that capital to repay the debt. Or once you start getting slightly more cash flows, you can use a part of it to repay the debt. It helps you avoid dilution at an earlier stage. So instead of diluting 20%, you only dilute 15%. But venture debt is only possible if you're raising a large equity round and if you have some cash flow. I would say strong cash flow. You need not be profitable, but at least you should have strong cash flows. You should be raising a large equity round. At very early stages, it's not possible to get debt unless you take debt from, let's say, a friend or someone, and instead of giving them equity, you just promise them a whatever monthly return, some interest rate. That is possible, but debt only starts coming in once you have grown to a certain stage. I would say Series A and beyond. Slowly, if you become slightly larger, let's say you have your monthly revenue in a few $1 million, and then you already have raised 20, $30 million. You have very strong cash flow. You have become profitable. Then you can raise money from a venture NBFC instead of raising capital from a instead of raising equity from a VC firm, and use that money to grow. So NBFCs are still keen giving debt, but to later stage startups, not at early stages.
Got it. Yeah, that's a good introduction to venture debt for the founders who are looking for that option. And now talking about the Indian startup ecosystem in general. So been
Mhm.
seeing it for the past some years. So how do you see it evolving? And do you think that right now is a great time to build a business in India, even despite the difficult times in terms of fundraising, or do you think there's still a great time to build a business here?
To me, the biggest advantage of India is that no matter what you want to do, like what industry you pick or whatever sector you pick, there is growth. We are a young country, we are a poor country, and we are growing quickly. So right now, the base is quite low in all industries, and then the potential to grow is really high. Maybe rich countries can't grow as much as India can grow. And that's why the entire world is banking on India and say, hey, this is maybe the next China. This is where the returns are going to come from. If I'm a young founder, I would be optimistic about the country because they're all good signs. We are checking all the right boxes and then build something that I am passionate about. Because no matter what you build in this country, if you want to build a consumer brand or a fintech company or a SaaS company, anything around agriculture, space tech, deep tech, there's potential in everything. And then now, thankfully, there's money for everything. There are funds who are investing in deep tech companies. That wasn't true 5 years ago. There are funds who want to invest in agri-tech companies. So it's a great, like, to just to answer your question in one sentence, it's a great time to build a startup in this country because of the growth. Because we're a poor country, there is growth, and sky is the limit, I would say.
Absolutely, totally agree. And we've had some interesting stories coming from the startup ecosystem in India. Some great success stories, also some stories that were thought to be successes but eventually didn't turn out to be. And one of them being recent one, which is in news, it's Byju's, right? So they were doing really well. One of the poster boys in the Indian startup ecosystem, and biggest edtechs almost across the world, right? And now it's not playing out as it should have for them. So what do you think went wrong, and what can other founders maybe learn from that?
Byju's has been a real unfortunate case for India because it was, as you rightly said, India's poster boy. There was so much VC money riding into it. There were all these big investors who had invested in Byju's. They saw, hey, edtech. This was the most valuable edtech company in the world at one time. But what went wrong, in my opinion, was poor corporate governance. Unfortunately, you would so if you look at venture capital industry, historically it has been a very high trust based industry because of the founder background. Usually, startup founders are educated people who come from top universities or who have left their good white collar jobs. Historically, there has been very low due diligence from VCs, even in mid or late stages. There has been very little oversight from VCs. So they might have a board seat, or sometimes they don't even take a board seat. They only have an observer seat. They're always willing to go with the founder because the general mindset, and which is correct, is that founders build the company. Investors don't build the company. You don't want to micromanage a firm. The only reason you are an investor and not an operator is because you realize that you can't build a company, but you can help them build a company and then make a lot of money. Unfortunately, in Baiju's case, it was just that the founder and the board, they made a lot of poor decisions. There was zero corporate governance on the board side. The founders just had an open hand. And I don't know, but there have been so many stories of founders siphoning off money or money leaving Baiju's. They're just burning money. So they're not, I think just recently they filed the FY23 audited financial statement. They filed FY22 a few months ago. So these are poor signs. Like there was a lack of oversight from the investor side, and also founders, in my opinion, they were not totally honest with the investors. They just took investors for a ride. They thought even though investors have put in money, it's our capital. We can use it in whatever we want. And in the end, it just led to a disaster. Like everyone lost out.
Absolutely, I totally agree. Certainly, something looks very wrong on the corporate governance side. And also, do you think that, was there anything wrong with how they were building the business, or do you think that the business side was functioning perfectly fine? It's just the corporate governance labs that led to what is happening right now. What do you think?
In my opinion, maybe it wasn't a company that was meant to become $100 billion company. Because the idea was that you can digitize all the courses, but eventually, what next? So they said, all right, we'll digitize courses, we'll start acquiring smaller edtech startups all over the world. They spent a lot of money on acquiring startup, but they acquired White Hat Junior for, I don't know, $500 million. Then they had to shut down the business. So on the business side also, they did a lot of poor acquisition. And the reason was why they did was because they had so much money. Investors were just pumping in money, and maybe the board and the founders didn't know how to use it. So they just thought, hey, this is our money, we can use it whatever we like, we can just gamble it. Secondly, before all this happened, you might remember, like since 3 4 years, Baiju's always had a lot of dissatisfied customers. They always had negative press. There were always parents complaining that hey, the guys just call us, they force us to buy courses, something we can't afford. So maybe the business model was broken even at that time. Once they started growing really quickly, once there was pressure to grow quickly from investors, and also founders wanted to grow quickly. But no one really batted an eyelid then because the company was doing well, the valuation was increasing. So the general mindset was, hey, all is fine. Like all companies have dissatisfied customers. There's not a problem. Let's keep growing. But once the valuation fell, and it's of course easy for me to say that in hindsight because I'm not a founder, I didn't build that company. But maybe at that time, 4 or 5 years ago, when they were getting the bad press from their customers, the founder and the board should have taken a decision and say, hey, this is not how we want to grow. We don't want to build a company that has such poor customer satisfaction. But no one said anything at that time because money was flowing in, the company was growing, valuation was skyrocketing, and then eventually they all lost out.
Absolutely. Yeah, totally agree. I think some very valuable lessons from for founders to derive from that entire story on corporate governance and how to build a business and how customer satisfaction has to stay in focus no matter how big you get, right? Awesome. Right. And now let's move on to the end of this episode, wherein I'll ask you five quick questions about the investing that you're doing through a syndicate, and you have to give five quick answers. Sounds good?
How much time do I have to answer every question?
As quickly as possible.
Okay.
The first one is, what are the sectors and regions you invest in?
Sector agnostic. We are fine with everything around tech, maybe not real estate, prop tech. Regions, India, we have invested in Brazil, invested in US. I would say India, US, emerging markets.
Great. What's the typical stage of investment?
We like to invest in post-revenue stage. I would say pre-Series A or Series A. Typical check size is $100 to $200,000. We co-invest with a larger fund. We never lead the round.
Great. Where can founders apply for funding in case there's a direct way?
Easiest way is you send us an email. You'll find it on our website, or there's a form on our website. You can just go and fill it.
Great. Where can our listeners follow you?
I think LinkedIn, like I'm mostly active on LinkedIn. So yeah, LinkedIn is a good platform.
Absolutely. There are a lot of valuable posts on Pushkar's LinkedIn as well. So certainly do go check them out. Thanks so much for making time for this, Pushkar. It was a pleasure hosting you, and I wish you happy investing.
Thank you, Prashant. Thanks for having me. Enjoy your day. Bye bye.